For the past few months, you have to say that REIT has never been so cheap, attractive price up against overall equity markets. So if investor is having the equity portfolios, I will encourage investor to look at the REITs because some REITs is extremely cheap. And given the fundamental is recovering, probably it's time to invest.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. My guest today is Henry Chin, Global Head of Research at CBRE. Henry brings over 20 years of research experience in the global real estate markets to our conversation, and he's with me to review some of the key themes in CBRE's 2026 real estate market outlook. Henry, welcome to the podcast.
Good to be here, Sarah. And today what I want to address with you is pretty much talking about the market dynamics. It doesn't reflect to CB as a revenue projection.
So, Henry, first off, what would you say is the overall mood among commercial real estate investors today? And how do you see fundamentals shaping that mood?
I think, Sarah, it's fascinating because at CBRE, we have conducted a global investor intention survey in December 2025. And I can quite honestly tell you, the sentiment coming from the investors to invest into commercial real estate markets in the US has been so strong. So more and more investors want to deploy capital into the real estate market in the US this year, 2026, on the back of recovering on the market fundamentals and the interest rate is trending down. So therefore, fundamentally, we are expecting to see investors going to invest into the real estate market here in the US in 2026.
And how does that really translate into investment activity during this year?
Okay, this year we are expecting to see the investment volume to increase by around 16%. I think last year we saw the final number. I think the volume has already up by 23%. And the building out the momentum this year, we continue to see the volume to increase, which is similar to the volume what we are seeing in 2018, 2019's level.
And according to CBRE's report, total returns this year will be income-driven rather than appreciation-driven. What's the main reason for that, and how should investors respond?
I think this is fascinating. I think the total return, we all know that's the MOI income plus capital gain. I think this is cycle because the 10-year Treasury is lingering around 4%. So therefore, the cap rate compression is going to be relatively mild as the market. But we are seeing the fundamentals are recovering. So prime assets, good locations, and across all the segments, we are going to see the rental growth. As a result, the total return is largely driven by the rental growth. We are only going to see some strong capital value gain when the 10-year Treasury trending down below 4. But as of now, most of the total return are driven by the income growth.
Let's talk about supply. Do you feel that we're seeing some encouraging signs across a range of property types?
Absolutely true. I think, Sarah, when I refer to our investor intention survey, we ask the headwinds, we also ask for the tailwinds. 80% of American investors, they are saying imbalance of demand and supply will be a tailwind for the commercial real estate market in 2026 here in the US. And particularly office and retail, we haven't got much of a new supply coming to the market into 2026. As a result, it's helping the market to recover in both asset classes. And multifamily, industrial, got a different noises coming through. For multifamilies, some Belt market does have a substantial amount of supply, so working through the supply issues. But the market like New York, Chicago, San Francisco, LA, in the Orange County, there's not much of supply. So therefore, the demand continue piping, and then the rent will continue to grow. For the industrial one is over the past few years, we do have a substantial amount of supply coming to the market. As of now, speculative development has quieted down. So therefore, we are working through the excess supply. And nevertheless, I do think the demand supply is definitely favor for 2026 investment thesis.
And your report also highlights a recovery in office leasing activity for 2026. Is that recovery limited to major markets like New York City, or is it more broad-based?
I think short term is more broad basis. I think we already see the recovery has happened in Manhattan, New York City, and the Silicon Valley in the Bay Areas. But when we are looking all the cities, I think that demand has come back. It's driven by finance sectors, insurance sector, and tech sectors. But however, the recovery, I have to say, Sarah, is largely concentrated in the best quality buildings in the best locations. So is that broad-based? Yes, but very concentrated in specific product type and specific locations.
And what about the Class B office assets? Any hope for those?
It's very interesting. I have to say, because we're talking about imbalance of demand and supply for market like Silicon Valley and Manhattan Park Avenue, the grade A space is pretty much down. So therefore, we are seeing the spillover demand coming to A minus and B in the prime locations. So this is coming through slowly and gradually, but as of now, it only happened in Manhattan and Bay Areas. But when we see the stronger leasing activities across all the major market, I think it's going to be quite an interesting trend to watch now in 26 to 27. So that translates into the investment strategies. So it's very interesting. Based on our survey and what we believe, more and more investors are willing to take the spaces in the so-called grade B asset in the prime locations because they think there's not much supply. At some point, they need to lease my spaces. So they bought this kind of asset through the value-added strategies in hope for we can catching out the rental growth. So this is some interesting trend we're expected to see in 26.
And are you seeing any recovery yet in life science real estate? And how does that segment compare with the broader healthcare market?
Well, the life science, as you know, during the COVID, they were a hero, and now they are facing some tough challenges. Again, real estate is such a cyclical asset classes, so it's always a demand and supply. I think what they are facing the toughest challenge is the huge supply was delivered into a life sciences segment. Unfortunately, I have to say, 2026 is continue to be challenges because there's so much supply in these spaces, demand about to recover. However, if I'm wearing my occupier's hat, I'm probably going to negotiate my leases in 2026 because the bargaining power is sitting on the tenant side. So if I want to do flight to quality, negotiate the best deals, 2026 will be the good year for quite a lot of companies to do so, particularly in the life sciences spaces.
Do you see any potential for adaptive reuse in that sector?
Well, people are talking about that reuse the spaces as of now. Pretty much most of the conversation are happening in the Silicon Valley areas because you saw there's not much of a supply. The leasing has coming back. People are talking about the Bay Areas, but as a widespread of a national phenomenon, it just not yet happened because we are still working through the office recovery stories into 2026.
And you touched on industrial earlier, talking about oversupply. Where do you see industrial fitting into the mix this year?
I have to say, Sarah, industrial markets was a surprise to us in 2025. Given liberation dates, given the tariff situations, we were very cautious for 2025 leasing activities. But surprise, 2025 was so strong. And leasing volume is the second best year throughout history. And I think the momentum will continue. I think the larger driver is coming from 3PL as well as reshoring activities. I think 3PL will continue to drive the demand and the manufacturing activity because of reshoring. So that's what we are seeing. And in terms of the markets and the specific quality of assets, it's likely to happen in those major transportation nodes and also closer to the major consumers. We are going to drive the demand. As a result, we are forecasting that industrial leasing volume is going to increase at least by another 5%. So therefore, it's not as good as what is seen in 2025, but the momentum will continue to build going through into 26.
And Henry, if you could, where do you see the most potential for commercial real estate this year? Where do you see new opportunities coming?
I know everyone loves to talk about multifamilies, industrial, right? Because those two asset classes continue to dominate the investment horizons. In my personal views, I think I can be a little bit contrarian. I do think when we talk about imbalance of a demand supply, wider recoveries, I probably want to look very closely into the office as well as retail because the fundamental momentum is building. And it's only, as you said, in the major markets, in the prime segment, I think that once the market, we feel comfortable, we're going to see the wider, stronger recovery. For multifamilies and for industrial, it's something very interesting. I think if you only multifamilies for a few years, if you're close-ended funds, I probably won't go to sell because I can realize my return. The market has performed so well. And then if you dispose of some of the assets, probably you can get a decent profit coming back, particularly for the close-ended fund. For industrial, similar stories. If you invest a lot earlier, time to sell. But if you had the modern facilities, industrial transportation now, I think they will continue to outperform.
And just looking specifically at the REIT sector, what do you think you'll be watching most closely in the coming months?
I have to say, Sarah, I was watching REITs very closely for the past 18 months. And then now I was continue to thinking about, we did some analysis, look at the P ratio for US REITs versus over equity market. And for the past few months, you have to say that REITs has never been so cheap, attractive price up against overall equity markets. So if investor is having the equity portfolios, I will encourage investor to look at the REITs because some REITs is extremely cheap. And given the fundamental is recovering, probably it's time to invest. And then the second component is because we are very positive about recovery stories in the private market. So therefore, US REITs performance will continue to outperform. So I do think 2026 will be the good year for commercial real estate market here in the US.
And Henry, finally, any other themes or topics from the outlook that we haven't touched on?
I think for the occupier, yes, we are going to see some noises about a policy, about political issues. From the occupier point of view, I think 2026 will be the good year for them to act fast, because we are the early stage of recovery. So for company, for occupiers, for those spaces they wanted, it's another year for them to get a better deals. But when we are seeing the market has recovered, they are going to pay for the higher rent. And that's for occupier side. For the investor side, it's, yes, people all rushing into specific asset classes, but given the repricing has been quite substantial here in the US compared to Europe, compared to Asia Pacific, I think be bold about your conviction about real estate. It's all about the macro conditions. And that's why you need to understand your client, your occupier wants. You can underwrite a compelling story to close the deal.
Excellent. Henry, thank you so much.
Thank you, Sarah, for having me here.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.